Back, everyone, to the afternoon portion of our committee's meeting. We'll resume with the Finance Committee, and Dr. Spurgeon, I don't know if you have anything to say about this or if you just want to get started over to Jeff.
Mr. Bishop.
Great.
All right, get underway. Well, I'm excited to present the 2024 COP presentation. It's an exciting time to be at the utility. Obviously, things are transforming very quickly. My goal today is to go through the presentation. I want to do a quick overview in terms of how we develop the plan. I think that's important context for not only the board, but the public in terms of the level of diligence that's put into it. We'll walk through the key assumptions driving the plan, and then walk through the financial outcomes and ultimately the rate impact. We're looking for hopefully a board's recommendation to approve this in December. Relative to the budget process, I want to take just a few minutes to go through that. Again, it's important that you understand the process, but also the discipline that goes into that. As you see the report, I would highlight that there's really 10 months of activity that's gone in to make this happen. As we think about it, we go through and we start this off in the February timeframe. Javier talked about the 4 priorities that we come up with. We meet as an executive to level of work that needs to be done. Here's we focus on 5 years out, and from there we've really honed in on the 4 strategic priorities: resource adequacy, technology transformation and investment, two-way communication, and master facilities plans. We've talked in detail with the board about that over the past year. We also make sure that that aligns with our Power the Future 2050 goals. And again, that's all affirmed in the February session. Coming out of that effort, we really hit the ground running in March with the load forecasting work. And I would harken back to the conversations we had just a moment ago in terms of how we continue to improve in that area. That's really a focus. With that, then we get into our wholesale marketing model. So as you think about how does the system get run, how do we integrate with SPP, how does it all get pulled together? We do multi-year runs. Coming out of that in the May to July time frame, we meet with our individual business units and have challenge sessions on what we're moving forward to the ultimate budget for the prompt year. And we jump into what's called resource optimization sessions. That's a 2-month period where we have challenge sessions amongst the ELT, walking through specifically where our activities are, trying to hone in on exactly what will be the basis for the budget. And again, all that comes together for purposes of trying to make sure we've got the right outcome. We're delivering the outcomes that we need for our customers. I'll also highlight that we're in a bit of an unusual cycle. Board is very heavily engaged in near-term resourcing. We talked about customer demand in great detail, effectively since the first part of this year. We've also gone through and highlighted the processes, Brad, Lisa, Tim, in terms of how we've developed the load forecast. Coming out of that as well, how that's transitioned into the near-term resourcing plan, which the board approved in August. And Brad and his team did such a wonderful job of pulling together. So you've been in the middle of what we're about to present, probably much more so than we would typically. So we appreciate that. I think that'll help to make a much more informed decision as we move forward. As we move on to the next slide, we've got the material assumptions that drive the 2024. Again, we've got those broken down by major assumption. Out of the gate, in terms of revenue adjustments, we're projecting a revenue adjustment or rate increase of 2.5%. Take this very seriously. We know this impacts all of our customers, especially in the climate that we're in right now financially. We make sure that we reduce that as best we can. What we're proposing, and we're going to go through this in more detail, is a 3.1% increase in base rates. And then relative to the FPPA, we're forecasting a decrease or requesting a decrease of 0.6%. So net those two together, it's a 2.5% increase. I would highlight this comparison to inflation. When we look at general inflation through September, we're pretty proud that we're able to be lower than that. General inflation is at 3.7%. As we look at the energy sector, over the past 24 months, we've seen a 15% increase. And highlight relative to EIA data, looking at 21 versus 11.4% increase in rates that are being seen out there. So we feel very fortunate in the fact that what we're bringing forward to beat that. I would highlight the focus that our team has to make sure we're as disciplined as possible to keep costs in check and keep the impact to customers as low as possible. As we look at retail energy sales, again, we're seeing an increase of 5.2% over last year's budget. Driver of that is growth. We're seeing that across all customer classes, residential, commercial, and industrial. Largest driver is in the industrial category. But again, I'd highlight that this load growth is critical for our efforts as we look to invest in our people, program, and assets. So it's important that we have that growth. Wholesale revenues, in terms of dollars, we see a decrease of 16.5% over last year's budget. When we look at that, there's really two components coming into play. We'll talk more about this in detail. Lower congestion hedging revenues are driving that down. And then also as we have less to sell into the market as we continue to see our load growth increase.
Hey, Jeff, just for clarification, to explain the difference between budgeted and projected. For instance, we will be establishing the budgeted 2024 here shortly, but the projected is what the actual.
That's what we're forecasting right now for the end of 23. So we're really looking here to say that in December or November of last year, here's where we set wholesale revenues at as we're projecting forward for the end of the year. How's it actually land? Okay, great question. I'm going to be typically doing a budget on budget comparison, but happy to walk through any of the numbers that folks would like. And specifically, as we get down to purchase power, that's an interesting one. So we see that an increase in 5% over last year. And again, that's due to increased market purchases to serve our load growth. Relative to what we saw for our 2023 projection, we saw that it's actually a decrease because we had less to actually increased unplanned outages in 2023.
Was this 5% more units, or was that 5% more dollars?
Dollars. So up top, retail energy sales and volume megawatt hours, and then all the other items would be in dollars. Thank you. Good question. All right. Let's go on to the next slide. So as we look at fuel expense, again, as we continue to evolve our portfolio, we see our fuel expense will increase by 9% or $14.9 million. That's largely associated with us bringing our new gas generation units online. So it's an increase in fuel costs with their first year of service. We expect those units to be online currently in Q3 of 2024. So naturally, we'd expect to see those costs increase. Relative to expenditures in total, when we bring together both our capital, and I'll talk about that in a moment, plus our operating costs, we see that our total budget would be $2.1 billion. So relative to what I just brought forward a moment ago, in terms of the expected forecast for 2023, it's about a 5% increase. And on the financing side, we're expecting to be active in the debt market. We talked about that a moment ago with our 2023 issuance. We're expecting to have net proceeds from financing of $424 million in the 24 budget. And again, that'll be utilized to finance our capital program as it always is. Move on to the next slide. Good news story here. As we think about the decommissioning trust fund, it's fully funded, so that's a success. Going through specifically what will happen for Fort Calhoun, we see that $15.3 million of contributions will take place to the fund, but that actually comes from the existing earnings that are in the fund. So it's a great outcome. It's self-funding. And as it relates to actual expenditure, so this is the work being done at Fort Calhoun. We're projected to have $115.3 million of decommissioning expense as a result of that. Next, we like to focus on our base load units. Those are the bread and butter in terms of making sure we can keep the lights on. We want to make sure that we're investing those appropriately. We see others that don't, and ultimately there are short-term and long-term impacts to that in terms of reliability and also relative to financial impact. As we look at our total base load budgeted costs, we see for 2024 in total, 28.8 million or 86 days that we'd expect those units to be offline, with Nebraska City 1 being off for 42 and North Omaha Station being off for 44 days. As we then move on to other outages that we don't have reflected here, again, we've got outages on Cass County units 1 and 2, and then also Sarpy units 1 and 2 as well.
Jeff, real quick, sorry, bit of logistics. This is listed as the 90-minute item overall, and so directors, if you have specific questions throughout, please go ahead. But from our discussion about the preparation for this meeting, we were anticipating about 45 minutes of presentation and then a Q&A at the end. And so if you have broader questions, please feel free to keep those for the end. We do anticipate a lengthy opportunity for discussion at the conclusion of the presentation. And I had promised Javier I would remind everyone of that in person today, and I missed it until the end of the executive summary. But
I forgot that too.
but thank you for that interjection.
Thank you. Appreciate the clarity. All right. Those are the assumptions. Let's get into the financial outcomes. So as it relates to the rate increase drivers, we've highlighted 3 here, and I'm going to start at the bottom. When we think about overall costs and what it takes to operate today, we are seeing inflationary pressures, just as everyone else is throughout your personal lives and as well as your professional lives. In addition, in terms of power costs, we continue to see those increase, and we'll talk about that in a moment. And then in terms of our capital, we continue to have a robust investment in terms of our capital portfolio, making sure that we're focusing in and investing in our existing assets, and also making sure that we are focusing on our key priorities, like I talked about a moment ago, our technology, master facilities plan, and resource adequacy. A couple of other items to note just relative to O&M costs, inflationary pressures. Again, we're seeing that in labor, parts, our cost to borrow. I'll highlight that in terms of our capital portfolio. We talked about specifically where the market was when we first had projected to go out and do our debt offering and where it ended up. We're continuing to see pressure relative to rates, and that continues to put pressure relative to our debt service coming off our capital portfolio.
Jeff, quick question. Is the higher margin that we have now, is that part of the rate increase driver, or is that really nothing?
The higher margin.
The higher, so that we have to have a higher reserve margin that we have for the utility. Does that drive some of the rate increase, or is that?
That would be baked into our total power cost. So as we're out purchasing capacity, that would be part of our purchase power.
If you remember the change we got from the Southwest Power Pool going from 12% to 15%, it's a requirement we have to meet. Since that change happened, we really haven't added we haven't brought any new resources online. We have had to go out and purchase capacity, as we always do. I think something that I want to make sure that we touch on explicitly is that the near-term generation portfolio that was approved by the board in August, eventually, as we talked many times, that will very likely result in additional rate pressure, but that's not going to come to us until late in the 2027, 2028, that time frame. What you're seeing here now is just current operations as they are, and I think as Jeff mentioned, it's getting more and more expensive to serve and buy power in the market, et cetera, but it's not related to those new investments. Those new investments are yet to come. And I think it's important, you and I talked about the distinction between these rate increase, so fund current operations, fund current challenges, solve current challenges versus the anticipated rate increase that we expect from the new generation that will come online later in 2027.
It's an important point to clarify. Thank you, Javier. All right. We'll walk into each of these in more depth here as a moment, but wanted to highlight the basic drivers again. Not a surprise, inflationary pressures. Again, we're active relative to our capital portfolio, and we are seeing our power costs increase our cost to serve our customers. We go on to the next slide, please. I will pause for a moment just to appreciate the healthy financial picture that this provides relative to our continued increase in wholesale revenues. We'll highlight this, that the residential customers do anchor our overall revenues, followed by commercial and lastly industrial. As we look to 2024, we can see that we expect to exceed the 2023 projection by 86 million, or 9.5%. That's important to note because those additional, the 86 million is important relative to funding, covering our costs, investing in our people, making sure that we're able to invest in program and assets. If that wasn't available, we wouldn't be able to do that. We'll highlight this, that industrial growth outpaces our other customers. We are assuming a substantial amount of growth. I'll highlight in the forecast, we've got residential projections to have almost 4,100 new customers come on board. If you multiply each of those by 2.5, that's what we assume is in the house. That's 10,000 people. So a 2.9% growth rate. I'll highlight this just from an observational perspective. As we're out driving around the community, it's amazing to see the number of new housing developments, apartments, commercial space. I think that really resonates and provides support. I'll also highlight when we look back at our 23 Q2 results, we saw year on year that Oppd added 6,600 customers. 6,400 of those were residential. When you convert that, that's 16,000 people coming into our area. So we really do see.
What period of time was that, Jim? I'm sorry. What period of time was that?
So this was Q2 of 2023. So looking at a couple months back when we presented the results, and then looking back a full year to see how many new customers came into the area. So this projection is a little bit lighter than that with what we've got in 24, but I would look back to 23 just as an example of the level of growth. And again, as we think about this should really be a refresh a lot of these assumptions as we walk through these in detail relative to the near-term resourcing presentations that happened over the course of the past 6 months. We move on to the next slide. Here we've got our net power costs, and this is, we like to pull these together because they balance each other out. We've got fuel and purchase power up top, and then also wholesale revenues across the bottom. There's a storyline here to tell. When we look back at 2021, we see that things are quite elevated on both sides of the ledger, both our costs as well as our revenues. That was the polar vortex. We saw incredibly elevated market prices. As we move into 2022, we see the same thing as well. We saw, not to the same extent, but we did continue to see higher commodity prices, really driving both our costs on the upper side as well as our revenues on the lower table to be elevated. We've now seen in 2023 that costs have come back to normalized state. As we look forward, when we look at fuel, we see that fuel will be increasing by $15 million or 9% budget to budget. Again, as we continue to add our new natural gas peakers, those will be generating, and also we'll be incurring the costs associated with fuel for that. Relative to purchase power, on the blue, we see that in addition that we expect a $15 million increase. And again, that's with us going out to meet our increased load. We're out actively in the market purchasing that power. So that's a 5% budget on budget increase. When we get down to wholesale revenues, we continue to see that decline. That's not surprising. We're continuing to use a portion of our generation. We're not able to sell it to the market because we're using it to serve load. We're also seeing that our congestion hedging revenues are coming in less than they have historically. As we've looked at, it's correlated to natural gas pricing. As natural gas prices have come down, as I talked about in 21 and 22, we're also seeing the expectation that those hedging revenues will decrease as well. And so that's really the two drivers. We're seeing a $23 million decrease between budget on budget for wholesale revenues. Let's move on to the next slide, please. Here we've got our operation and maintenance expense broken out by major category of spend: A&G, transmission, distribution, production, and customer. Before we jump into the budget on budget comparison, it's important to call out 2023. What we've got projected here is the $50 million pension contribution. We talked about that just a moment ago before lunch, that would be incurred in 2023. We're required to recognize that as an expense. So you'll see that 2023 is elevated by that amount. And then we've also got some higher production costs associated with experience in 2023. As we look at the drivers between 24 budget compared to 23, we're seeing about a 9.5% increase, which is substantial, but we would highlight that there's a number of factors coming into play. One is inflation. We're continuing to see higher costs for parts, for labor. As we're out in the active marketplace trying to retain talent, costs are continuing to increase. It's a very competitive market. We're also seeing that our outage costs are coming in higher than we had in 2020, than we had budgeted in 2023. And then just across the board in terms of the amount of headcount that's needed to support our generation growth and our enterprise priorities continues to increase our O&M costs. More specifically, I wanted to go through the categories. So we look at transmission and distribution, we see a $17 million increase. A substantial portion of that is associated with headcount growth. We've got 23 FTEs coming on between, and that's being spread between our engineering teams, crews, and asset management. I will highlight this. We've had a number of different questions that have come up about customer connects. What are we doing to make sure that we're connecting customers as quickly as possible? We do hear from time to time from different organizations as well as individuals, concerns that they have with our time to get them connected. Relative to that, we are investing in those areas. So we're doubling the engineering function between our outside engineering resources, and we're also increasing our internal capacity by 40%. If we look at 23 versus 24, again, really making sure that that's not the bottleneck. We've got the right resources available to get the work done. Customer service is also adding a project manager to focus on development projects to help make field work as efficient as possible and reduce work and also just delays that happen in the process. And as it relates to our general and residential business work, we're really focused in on making sure that one, we've got the right level of people. We've got a new electric service designer coming on in 2024 to really help facilitate that work. I had an opportunity to go out recently and be out in the field, which was fantastic. See what they do, see all the different coordination points there. They are really the coordination point between the customer and the utility. So our focus is to make sure that we're being responsive to those customer needs and that we're staffing up appropriately. So you'll see a good portion of that come through the T&D area. We're also seeing cable locating coming in substantially higher. $3 million is what we've got in this year's as an increase. We've just every year we continue to exceed our budget with the number of required cable locates. And so that continues to be something we want to make sure that we budget for appropriately. And then just more broadly in terms of investment in resource adequacy and two-way communications, as we look to advance those priorities, we've got to bring people on to facilitate that work. I'd also highlight just a moment more about just the amount of work that's going on at the utility. As we think about vegetation management, 850 miles of vegetation management. That's critical to ensure that we've got the right level of reliability on the system, making sure that we're up on top of that, that we're maintaining the cycle of vegetation management, that we can get repeatable. That's where we're at. So in terms of helicopter inspections, 900 miles, transmission detail inspections, 350 miles, and pole inspections, almost 18,000 poles. What I'm trying to highlight is the amount of work that goes on behind these numbers that people won't necessarily see. But that's been a big focus by management teams in those areas to make sure we're held accountable, to make sure we've got the right reliability for our customers. We need to be staffed up appropriately to get that done.
Chuck, you said those are all in the T&D.
The way I explained in terms of like the customer, the folks that would impact the customer experience, a lot of that's in T&D. There would be a couple that would be in customer service and A&G. But great question. Yeah. When we get to production, we're seeing an increase there of $16 million. Again, headcounts is a large portion associated with that. We have seen, as we reflect upon the outage experiences that we had in 2023, folks working months on end with no days off, 400 plus hours. We want to make sure we're staffed up appropriately in the future so folks can have the right work-life balance. We're also seeing in terms of outage costs an increase of $5.2 million, 23 versus 24. And then in terms of just additional dollars associated with resource adequacy, additional investment. Next, as we move to A and G, I differentiate that between customer, but it's going to be the lower number, brown. We see that we're going from 152 million to 167 million. So $15 million increase. You're seeing that's driven largely by costs. So medical costs, 5.1 million of additional costs for medical, pension, 6.5 million being the two largest drivers. We've also got some additions to headcount, notably to support our technology work. Kate did a fantastic job to highlight the amount of work that's needed in technology, not only from a cyber perspective, keeping us safe, but as it relates to the backbone, tech transformation that we've talked about relative to priority 2, priority 3 on AMI. Those take people to get that work done. And then also in terms of safety and facilities, those are the largest areas that we've seen in terms of headcount, making sure as we think about the master facilities plan, we've got to have people in place to get that work done. Director Mohan.
So in 23, we budgeted 152 and then but our actual is coming in much higher than our budgeted for last year. Can you give me an idea of what?
That's great. That's a pension expense. That's a $50 million. So you see it's about $51 million difference. That's because that comes through, pension gets booked to A&G. Great observation. Change.
Since you already gone through all the categories, if people aren't keeping tabs, so the FTE increase that we're planning for next year, we're talking about supplies, materials, fuel, etc. But none of these can be done without people, and so there has been a concerted effort to make sure that we are very conservative and that we're good stewards of people's funds, and at the same time that we are aiding our existing workforce with the numbers that we need. What is anticipated FTE increase?
155.
155 net more employees than we have this year.
Yep. And that's still down from.
And so at the end of this year, we'll end up close to, and don't quote me exactly, but it's about 2,100, a little bit less than 2,100. So we're adding 155 more, which is, it's a very significant addition because you have to take into account all of the retirements, promotions, lateral movements. So our human capital team is going to be super busy. That translates into over 400 vacancy processes that will net, hopefully, or at least part of the budget, it's 155 new people. We're growing, we're adding many miles of street lights, of distribution lines, transmission lines, customers to serve. I think that's very important to highlight. OPPD many years ago, back in 2015, we were at 2,300 employees. We aren't there yet.
That was with Fort Calhoun.
That was Fort Calhoun, and we reduced a lot of employees, and now we have slowly built that workforce back again. I wanted to highlight that piece because that when I talk to employees, I go to different sites and I talk to our employees. They want to know, what are we doing to help with that work-life balance.
So, sorry for clarification, we expect to be about 2,100 at the end of 2023. We expect to be closer to 2,250 at the end of 2024.
I will get you the exact numbers by the end of the meeting.
Yeah.
You can text me and I can.
Okay.
Get that pulled together. I would just accentuate what Javier said in terms of the focus on people. We had many discussions around what people were asking for, making sure that obviously the positions are needed, but then also challenging too, to make sure if we can push something off, walk before you run in terms of how many people you add to an organization. Many hours devoted to really fine tuning that 155. So I want to provide some confidence as people look at that increase, that we had a very diligent process to go through that. Go to the next slide. I'm going to take a few moments to talk to you about our CapEx program. You'll see that, as I talked about before, a sizable request. An important piece of how we look at it is philosophically, we break it apart into 3 different categories. 30% of that are sustained, expand, and then enterprise priority. Sustain is making sure that we're investing in what we already have today. We're maintaining our existing assets. With that, we want to see that where the request is for $219 million or $218 million, excuse me, of sustain. And that's an important piece as we think about making sure that we're enabling the reliability that we have on our T&D assets or generation assets. We'll highlight this. We oftentimes like to go back and benchmark our historic depreciation. I'll go back to like a 5-year run rate of depreciation. It's about $160 million. So this makes us feel good that we're continuing with the 218. As we continue to add more assets, continue to grow, that we're investing reasonably in sustaining the existing assets. And we've seen if we don't, what happens in terms of reliability. So that's a continued focus. As we go on down to the expand, so this is our existing footprint, but where we're continuing to add to the district's base. We see that's 15% or $105 million. And again, when we think about different projects that come into play, that's different residential projects in terms of underground comes into play, overhead electric facilities, different substation transformers for new developments. Those are the dollars associated with the expand. And then as we think about where is the organization going, we've talked a lot about enterprise priorities. It's 56%. And specifically are $403 million. And as we think about that, that goes back to our priorities. AMI projects is about $43 million of it. Master facilities plan, $67 million. The breakdowns of specifically all of the capital projects can be located in the COP book. And that has good detail in terms of what the specific costs are going to be for those projects. But again, I would highlight that that really goes back to the 4 priorities that we've highlighted earlier: resource adequacy, technology transformation, two-way communication, and then master facilities plan. Let's keep moving to a more detailed breakdown of the capital expenditures. Here we see how it's broken out by different categories. So you see in total, we would be increasing the 2023 budget is 640. Again, we talked about the excess expenditures coming through. We expect it coming to 651 as projected for 2023. We're increasing that to 727 million for purposes of 2024. And again, as we look at the drivers, the biggest drivers here will be in your T&D section. That's the middle blue section, about a 24% increase. And again, that's associated with additional investment in the electrical grid system focused on reliability in our growing community. If we go down to the general, we see that that's 13.4%. And specifically with that, the driver being associated with the investments we have in investment technology in our master facilities plan. And then production is one would anticipate in the brown down at the bottom. You'll see that we continue to invest at relatively the same levels. That's grown over the course of time with our Power the Purpose. I will highlight that in 2024, again, we'll have the 2 Power the Purpose projects in service. So that's what's continued to drive the 2024 budget need. All right, let's get on to how do we pay for this? We've got rates, and then we've also got our financing plan. So here's a consolidated view of our long-term financing and debt ratios. You can see here that similar to 2023, we're going to be active in the marketplace. We've talked about that. Our focus, again, will be to ensure that we've got our days cash on hand between 150 and 200. We're maintaining that AA rating. That's critical, especially as we continue to move forward. As we look to higher interest rate markets, that's where this really pays off to have that AA rating. With that, again, we've talked here, we've tried to highlight the refunding. So when folks look at the dollar amounts, you can see in total, for example, for 2023, we had new monies of 361 million. We had the refinancing of 89 million and the payoff of our commercial paper of 100 to get us to the 189. So we tried to highlight really how those dollars are being used. And again, you can see here how that rolls out over the course of time. Relative to our debt ratio, We feel very comfortable with where we're at. We see that from a 23 budget to 24 budget, we're going down just slightly from 67 to 66%. So we feel like we're in that sweet range. We can continue to maintain our AA rating as we work with the agencies. We presented this plus a 5-year outlook to the agencies in September. And again, that was supported by that AA rating. So we feel very comfortable with these projections. Let's keep, we're going to move to the next slide. So one item that's unique to OPPD is we do hire a board consultant to do a budget review. Rattle, independent set of eyes, not required, but definitely a best practice in terms of having someone independent come through and test your assumptions. Should provide you some assurance, but also management assurance that we're looking at this correctly when we put together our plans, that there's not any gaps or holes that have been seen. And so we had a number of virtual half-day sessions. Appreciate the staff time to go through that with them earlier this quarter. And then as it relates to the final summary, they've seen no issues with the plan. We'll have a finalized report that will be available so folks can look and make sure that that has been attested to by the consultant. And these are all the different areas that they go through and test. Let's go on to the next slide. So in terms of next steps with the budget, we presented the all committee today. We'll be looking for feedback over the next month. So specifically different questions folks have, please make sure that you're bringing those forward to us. As it relates to December, we'll present any changes that come forth. Typically those are minimal, but obviously if we need to do that, we will. We'll present those to the Finance Committee on December 8th, and then ultimately to the board on December 19th, and look to hopefully get board approval on the 21st. Any questions on that before we jump into the rate action? Okay, no questions. Let's move forward. All right, on our first slide, we want to provide a visual of how we compare ourselves relative to national rates. And this is average customer rate. And again, we continue to see over the course of time that our competitive edge, which is really important as we think about folks continuing to come in, they want low cost power and reliable power. And we do a fantastic job of that in Nebraska. And so as we look at the trend over time, you can see how we've continued to improve. We haven't reported this out yet, but this will be the item. Again, it's on a delay. This is for 22, but you see that our competitiveness compared to our national industry colleagues is roughly 26.5% below the national average. Again, we will see, we don't have 23 up and available yet in terms of the 2.5% impact, but we think that based upon what we've seen through observing others in our area, that we'll continue to increase that competitiveness. And that gets highlighted here when we go to the next slide. So here's a showing in terms of where we're at relative to other folks that are in the area. We've got everything from folks like in PPD where we've seen 0, and then others in the area where it's 8.4% with that's Alliant. So what you see here is in general industry trends, load growth, rising wholesale costs, supply constraints, and inflationary costs are continuing to increase across the board. And that's what's being really reflected in terms of the proposed retail rate increases. Again, this is our ability to go out when we're able to find public information and bring that forward, just for context, in terms of how we're comparing to others.
Jeff, on the previous slide, the competitive rates slide, can we look back there real quick? We look at this presentation in a couple different ways during SD2. I know we look at it. Can you remind us what numbers are reflected here for national and OPPD? This says EIA data. How is this number calculated? What does this reflect?
This will be very simplistic. So it's going to be your 2022 EIA data. So total revenues divided by total megawatt hour sales. So just plain average. It's not broken apart by customer class.
Something important here is that our board has asked us, has set the bar even higher. Our SD2 tells us we need to be at least 10% below, not the national average, but the regional average, acknowledging that we are in a region that generally has lower costs than the rest of the nation. And so when we have SD2 monitoring report, we'll go in depth, really looking at the region and looking at customer class by customer class. This is another opportunity for us to compare ourselves not only to the region, but to the nation. Because frankly, that's where we're getting a lot of customers, a lot of requests, new load coming in. They're not necessarily coming from neighboring states. It's not residential customers moving from neighboring states to here. It's national firms choosing within the national footprint where to come. So we thought it was prudent for us to show these at a national level, but acknowledging that really the board, our accountability to the board is even higher than that. This sounds great. It's even more important for us to be at least 10% below the regional average, which is.
Good. Yeah, just highlighting that this is a different presentation of the same information that we're viewing in a more detailed view at a different time. So we are aware that this is different than what has been presented at other times. But that is intentional. And then we will see more detailed information during SD2.
Sure.
Appreciate that. Thanks.
Okay. I'm going to keep us moving. So let's go one more slide. So as it relates to the 2024 rate action, there's a number of components to break apart here. It was useful to have our prior conversation in terms of the forgiveness. I've got that highlighted here. If we were able to utilize the decommissioning trust funds, we would expect to see a rate associated with that. Fortunately, we don't have that. That would be a component of which would be the under collection that would impact us in 2024. With that, again, as we've looked at the general rate increase, it's 3.1%. We've also gone back to look at specifically the FPPA factor, and that's composed of two pieces. There's a portion that sits within the base rate, and then there's also the FPPA factor, which we're proposing to decrease by 0.6%. So fundamentally, when your costs have increased or your generation has adjusted, that's a driver to move forward with doing that adjustment. And so that's why we're advocating for the general rate increase of 3.1 and the FPPA factor to decrease about 0.6%. And that gets us to a net impact of 2.5%. Other rate changes, if we can go on to the next slide. Couple items to note, retirement of a large power high voltage transmission level 261. There's not new customers that are currently utilizing that, so we can get rid of that class. Changes to our general, just a couple tactical pieces. Reduction in our activation fees that's associated with our landlords and non-landlords. It's a $2 drop. Reflects the cost to administer that it's decreasing with time, so that would reduce. Also, when we look at tenant attachment fees, this is pole attachments, those would be increasing by $2.15. Again, we're continuing to make sure that we're covering all of our costs associated with that, and we're continuing to see a large number of interests of people attaching to our line. So that's attaching to our pole. So that's an important piece that we make sure that they're charged appropriately. And then creation of new rates for our street lighting, rate 350. Again, every year we come up with new methods to address kind of the unique preferences that they have for street lighting. So there'd be 5 new street lighting offerings that are being proposed. Again, you can see this in the regulation standard. There's a red line that was put within the packet. Folks can find that on Diligent.
Clarification there. So you list rate 261 has no customers in it. We have a very similar titled rate 261M, but there is not any change. Those are distinct. 261M will remain. 261 has no customers and is being dropped, but 261M remains and is unchanged. Thank you.
Okay, let's move on to the next slide. So here we've got the proposed percent increase by customer class. Again, the detail of this sits within the service reg red line, which is out there for folks to look at publicly. As we go through and look at how we allocate the costs across our different customer classes, that's where we employ the cost of service study. Again, that allocates the cost according to how the customers utilize the system. Best practice in the utility industry it ensures that we're following a fair and non-discriminatory process and follows cost causation principles. Specifically, as we move across the different customer classes, some things to note. Residential customers, again, they'll see a total of 1.6%, with 2.2 being general, the offset of 0.6% being the FPPA decrease. And again, that's really based upon what we're seeing in terms of the cost causation principles. They would see a lighter impact from a customer class perspective. As we look at our commercial class, you see an increase there of 5%. Average impact to the monthly bill would be about $1.17. And let me go back on residential, it's about 44 cents a month that we would see in terms of the residential impact is associated with this rate, 44 cents bill increase per month. As we think about commercial, again, looking back at specifically how the system is being utilized, we are increasing the demand rate by $1.17 per kilowatt a month. And again, that has to do with how people are utilizing the system. That's being increased across both commercial and industrial. Lower efficient users will experience higher increases for those folks that ultimately are on the demand charge. But again, in total, about $1.17 per month that would be anticipated for the average commercial customer. Looking forward to our industrials, you'll see that general increase of 2.4, net of the 0.6 gets us to a 1.8% increase. An important point to note here that we are increasing the demand charge. Ultimately, when we look at this relative to them as an entity, the price increase, and we factor in the volume increase that's reflected, you'll see a very large change from a revenue perspective, right? So the volumetric impact of the amount of growth that's going through that area, while the price change isn't the same as commercial, you'll note that because of the volumes coming through, a substantial increase in the revenue impact. So again, it's important to think through price volume impact. That'll also come into play too when we look at our lighting.
On this one, you mentioned that different customers and different classes use the system differently. Is there kind of a general description of what are the additional costs that some classes use? I mean, I guess what I'm getting at is it's more expensive to use power on peak. Is that generally what we're getting toward?
If I may, I think, because I've asked the same question in the past, and probably the easiest example here is think about an industrial customer, for example. Typically, a very large industrial customer is located strategically very close to a substation. They're not in the middle of a neighborhood. Right? So the cost assigned to an industrial customer for sure is the generation, the transmission, but there's most of the time, if not ever, there's any distribution charges to an industrial customer. They don't use a distribution system like a commercial customer or residential customer. Therefore, they pay for only the parts of the system that they use. Your point also was important about who uses the system in different ways and the peak, et cetera. That has to do a lot with the load factor and how much, in this case, an industrial customer, generally speaking, is running all the time. They use the system much more efficiently than you and I in our houses, where we're not in the house all the time and we use a lot of power in the morning and then in the evening again. But I think the biggest piece here is in this case, the industrial customer that uses almost no, if any, distribution costs versus everybody else. We do assign distribution costs.
Yeah, and so
I hope that helps.
yes. And so the way that we structure our rates is sending an economic signal to our customers about what, where the costs are high and what they should do if they would like to, if they are interested in decreasing their bill, what types of actions should they take? And efficiency or shifted times of consumption or other types of mechanisms are good ways for them to achieve a low bill within the rate structure that we have. And so I guess I'm looking for kind of broad language that we can convey to people about what are the best steps for you to lower your bill if that is important to you. And so, peak power is more expensive than off-peak power. Are there other general, kind of broad language descriptions of what are the signals we are sending through our rate structure to our customers about what is the best way for them to achieve a low bill based on the different rates?
I think two answers to that, and I really appreciate the question because I think this is what advanced metering infrastructure is going to allow us to do at a very large scale. Today, we have those signals. If you look at our rate manual, which is pretty lengthy, it's over 100 pages long, beautifully written by our staff, by the way. Only a handful of those are truly rates as themselves. The remaining of them are rate riders. And those rate riders allow customers to engage and participate in different variations of their rate so that they can manage their peak and they can take credit for how they manage their peak, and they can lower or increase either their energy usage or their bill. So we already have some of those tools in the rate manual. They're not necessarily applicable to the majority of our customers because we don't have a way to meter that. But your point is exactly right. And we've been having these conversations in the past about the declining block rate structure and how that will come to the board in the future to change that and to send a signal for energy efficiency and conservation, and try to help incentivize a lower demand when we need it.
Javier, I would supplement your response that in the customer communication that we plan to execute in support of the rate change, where we break individual letters by individual customers by rate class, we'll also plan to include some links and indicators in there, because it is in a glass half full sort of way, an opportune time to draw their attention to ways to reduce their usage and reduce the bill. So we'll work to tailor that as much as possible to direct them to certain types of solutions that we offer. And then in larger customers that are represented by our account executives or senior account executives, they'll be having individual conversations with those customers, not only about the impact for them of the change, but again, reiterating ways to promote programs and do energy efficiency to offset some or all of the increase.
Great. Yeah, thanks very much.
Keep us moving on to lighting. So different story, right? Oh, sorry. We go back one. So lighting should catch people's eyes. It's the opposite story of industrial. So price hasn't gone as high in industrial, but the volume makes up the difference. On the flip side, we're seeing that lighting's going up, but in general, the amount of consumption's gone down with lighting as we've gone to LED conversion. So when we look at the actual overall lighting revenues increased over the course of time, because the volumes that they're consuming has decreased more so than the price increase. I will note though that also the capital costs associated with our street lighting has continued to increase, and the total number of assets out in the system has grown as well. When we look at this increase, we've gone around to look at others in the area. LES has increased in their rates in terms of street lighting by 9.75%. In 2023, that came through, and then NPPD, despite having a 0% rate increase, has increased their street lighting by 5.4%. So we think there's definitely a trend within the utility world in terms of trying to capture those costs, and how the cost causation has adjusted over the course of time associated with those accounts. Obviously, a lot there. We'll expect people to digest. We'll expect questions as well. We'll open up here in just a moment. I did want to get to our last slide, which highlights the work again that the Brattle has done for us relative to the cost of service study for 2024. And I won't go through this in detail, but it highlights specifically the methods that they're using. It's important that we do have them to perform that study. It gives us comfort, it gives the board comfort in terms that we're following the right rate making principles as we look to implement our COP into a rate structure for our customers.
And this is important, if I may add. I've mentioned this in the past, but I'll just as a reminder, what I really appreciate about this report is twofold. One, make sure that we're not spending too much. We're not overspending on certain areas. That we have someone a third-party consultant who's helping the board make sure that we're held accountable to making sure that we're spending the right amount of money. However, when I say the right amount of money, I am also very interested in that report to make sure that we are not underspending. So I see I look at this report from both angles as a CEO to make sure that we have a consultant that is giving us some benchmarking to make sure that, hey, we're applying sound principles that at the level of spend, the level of FTEs, supplies, materials we're assigning to these organizations compared to, proportionally speaking, it's the right amount, and that at the same time that we are not potentially starting to undercut or cutting corners or that, and that is important too, to make sure that I can have a corporate operating plan, a budget that delivers not only affordability, but delivers the tools that we need to maintain all the strategic directives that we'll have to monitor during the rest of the year. So it's a good report on both ways.
I appreciate you saying that, because that was kind of the question that keeps coming back to my mind as I look at our rate increases. Is it enough? Right? Is what you're allocating for new resources, for FTEs, all of that, like given the growth and the importance of the work, is it enough? And sounds to me like that's the needle you're trying to thread.
Right.
Open up the Q&A session.
I just, to piggyback on yours, I think about the unplanned outages that always seem to come on Friday night, weekend, you know. Oh, by the way, a part the size of 2 elephants has quit working and we don't have one on the shelf to replace. And all the headache and you know, the work that went behind the scenes to solve this problem is just huge. And so that's kind of my question. Is there enough allocated? I mean, maybe we'll have replaced all the old parts, but it's time 2024 rolls around. I kind of doubt that, but those are, they're significant fiscal challenges.
If I may, I actually had very good, very detailed conversations with a few members of the ELT. I'm looking at probably the main one here, Troy Vai. And we talked about that and the notion of contingency and setting aside reserves, whether it's reserves for storms or reserves for outages. And that evidenced itself to us in overtime and additional materials. And there's always a temptation to set aside more. We talked about margin. Dr. Buckner, you talked about that earlier. Are we planning any additional margin? And it's a tricky situation to navigate, because we could do that, but that would result in even higher rate increases or higher revenues collected from customers. We may or may not use them now. History tells us that we'll likely use them because we live in the Midwest and we have storms and we have outages that we don't plan. I think this is where our financial strength comes into play. Having a diverse portfolio of generation resources where we can still make additional money and recover some of our costs if our generation plants are offline. Those two offset each other. We had a conversation about overtime. We have seen an increase in overtime from our employees when you have unplanned outages and you only have so many people. And they've been amazing. The women and men who are working at our generation plants have done a fantastic job, but it hasn't been easy. I would rather address that issue with a longer term solution by right sizing our teams, having additional people come in and try to help, than by generating additional reserves for outages. But it is a conversation we have going into next year. Just like every year, we go in with some risks that we know are risks that we're incurring, and we may have a few more storms than we usually have. We may have unplanned outages, and we're just going to have to navigate through the budget season to figure out how do we meet those additional expenditures without having to completely disrupt the rest of the organization. Earlier this year, we had many conversations with the organization about tightening the belts when all of these outages were happening, these unplanned outages were happening. We knew that the end of the year was going to be a little tight, so we sent notices and we asked our ELT to
Yeah.
It's hard to sustain.
Also, a worst case scenario, Javier, we could revisit the rates anytime in the middle of the year, right?
That is correct. So a practice that the board has had all the time has been, we only look at these once a year for a number of reasons, for stability, provide stability to customer owners, et cetera. But there's always an opportunity if there's an emergency halfway through the year and our reserves prove not to be enough, we could always come back to the board. That's last resort, but.
You said reserve rate stabilization fund.
Correct. Yeah. So we have $50 million in a rate stabilization fund, which it hasn't changed. It's the same amount that we've had for many years. The organization is much larger now, so the effectiveness of that fund is coming down as the organization grows.
Is that, I mean, is that something we should revisit? Should we set a new target for that?
We are. I've already instructed Jeff to look into that and figure out what is the right amount. It may take us a few years to get there, but I think it's important for us to revisit that. And it'll come next year as part of the work that Jeff is.
So I was looking through all the rider schedules, the red line of the rider schedules. And with the rate increases per kilowatt hour, means that our cost per kilowatt hour going up. But yet in our co-generating and small power producing facilities, the avoided cost remains the same. And so at some point, wouldn't we assume that if our cost per kilowatt hour is going up, then the price that we pay people with co-generating facilities like UNMC or Oppd or all of those people with cogeneration would be also have an increase in the amount that they get per kilowatt. And in addition, for residential and small commercial, the avoided cost seems to me is going up, but the amount we're reimbursing our customers who provide that cogeneration is not going up. So have we ever looked at that? Is that something we've discussed?
I think that's a great observation. There's a number of factors coming into play. I know Tim Linnell, he's our rates manager, wasn't able to be here in person, but he is online. I don't know, Tim, could you hear the question?
Yes, I did. Yeah, thank you, Jeff. So that's a terrific question. We're actually in the process of updating our avoided cost study methodology, making sure it's following best practices and modernization. So that is a prioritization. As we look at how do we want to compensate our customers for avoided costs for different technologies, for different services. That is something that we're working, cross-functional group within the organization is on that team, and we're looking at that. Great question.
Thank you. Appreciate the answer. We'll be looking for that report.
So from the previous slide, we showed the rate changes by customer class, and then we've talked about the rate manual red line version. And at the end of the last item about the COP broadly, we talked about the outreach and engagement. Are we planning to share the entire corporate operating plan online and also the red line version of the rate manual for comments over the next 30 days? Is that right? And then is that intended to be on Community Connect, or what's the mechanism by which people can access that information?
Community Connect, and there'll be a link on oppd.com to go to community.
Great. Yeah, because we were referencing some of the more specific details that are reflected in the kind of top line numbers here by customer class. But if people are interested in any of the specific information, that will be available as well, which is something we talked about in the pre-committee meeting. I appreciate that being available for us. I want to make sure others have access to that as well. Because the idea about our rates of sending signals to our customers about the costs and if they want to change their behavior in order to achieve that lower bill, there are ways they can understand the rates as reflected in the red lines.
And Chair Williams, also the links that Tim referred to as well will be on that.
Great. Thank you. So Community Connect, as usual, glad to hear it.
Other questions?
I'm gonna, this is gonna be clumsy, but I'm gonna attempt to connect a couple dots for us today. We heard SD11 earlier, and talked a lot about the great work that's happening from an economic development standpoint. When I think about the way in which we're managing our costs and investing in the resources and people needed to accelerate development, those things kind of click into place for me. They connect really tightly. So in other words, like when I think about, Lisa, to the conversation we've had, like what does the community need? Right now, one of the biggest needs in the community is housing. It's affordable, clean housing. And so everything that we can do to keep those costs down for developers and move them through the process as quickly as possible is helping some of the community engagement development stuff that I think is really needed right now. So I like the way that these things came together, honestly. And I appreciate some of what you described earlier in terms of the investments that we're making in personnel to kind of get through some of the roadblocks that we've been experiencing and hearing about. I think that's a really good responsive posture for us to take based on what we're hearing from folks.
And if I may, that's a good segue. I do have an answer. It is approximately 2,100 employees that we're projecting to end the year or early next year. So that would be 155 additional people. Now you'll have some positions that are eliminated, et cetera, but it's just, it's a big number. It's a significant number.
I think it's important, to bring up the connection piece. It's important to highlight resource piece internally that we're focused on, as well as process. Like, how can we be more transparent? We have some pilots going with some builders on how they could potentially do, as they're building their facilities, take on maybe more of the work when we credit them back. We've also got some technology that we're using that allows us to communicate with each other as a small pilot, where they're seeing our schedules, we're seeing theirs, we can track changes, all that kind of stuff. So there's some process as well as resources that are coming here that I think is going to improve things over time. We've also been focusing on job site readiness to reduce the number of truck rolls that we'd have that are inefficient. So there's a lot of effort around that. Tim's team and my team's been working really closely with customers on that. I think we're making some good progress. And I will tell you that even if we get approval for 155 people, it takes effort these days to fill those. It's not like it used to be. So
And train.
I think teams are trying to move as fast as they can to get position descriptions and things ready to go so that we can move as fast as possible. But I'll tell you right now, it's really difficult to get engineers. That's a really tough place to be right now. We've done a nice job. Mikkel and her team has done a fantastic job. But it's not easy, and sometimes we're having to post these for 3 to 6 months before we get.
Questions, comments? We